COMEX just made a promise they cannot keep. 429 million ounces of silver committed for March delivery. The vaults, 85 million ounces. Read those numbers again. Promised 429 million, have 85 million. That's a 344 million ounce shortfall. 5 times more silver promised than physically exists in the system. March 27th is first notice day, 3 weeks away. Every trader holding a March contract must decide by then, cash settlement or physical delivery. If just 20% demand metal, COMEX runs completely dry. Not tight, empty. As I'm recording this on February 8th, something else is happening that nobody's talking about loud enough. 33 million ounces walked out of COMEX vaults last week. Not traded on paper. Physically removed. Gone. That's 26% of their entire inventory in 7 days. 4 years ago, COMEX held 430 million ounces total. Today, 113 million ounces remain. 74% has vanished. And the exit is accelerating, not slowing down. First week of January, 7 million ounces left. Third week, 33 million. This is not normal profit taking. This is institutional money, sovereign wealth funds, manufacturers, smart money loading trucks and draining vaults. Here's what makes this absolutely critical. The current silver price, Western spot is trading around $78. Shanghai physical silver, $100. Same metal, same day, same planet. $22 difference between paper and physical. Let me be very clear about how insane this divergence is. If silver was really worth $78, why pay $100? Why would sophisticated Chinese buyers, institutions that need metal for production, pay 28% more than necessary? They wouldn't, unless they know something. They know the paper price is artificial. They know $78 is manipulated. They know the real value is closer to what they're paying. And here's the part that should worry everyone. The gap isn't closing. Friday it was $25. Monday it was $28. Today, as paper crashes lower, physical holds. If this was a real crash driven by actual supply and demand, both markets would fall together. They're not. Paper is collapsing. Physical is holding steady. That tells you everything about what's real and what's fake. One of these prices is a lie. I'm going to show you which one. And I'm going to show you the mechanism. The weapon is called a margin hike. When you trade futures, you put down a deposit, usually around 10%. If you want to control $100,000 worth of silver, you put down $10,000. That's your margin, your skin in the game. If the exchange decides to raise margin requirements overnight, you suddenly need more cash. Not next week. Now, if you don't have the cash sitting ready, your position gets liquidated, sold out automatically at market price. And when everyone is getting liquidated at the same moment, the price at that moment is terrible. Rock bottom. CME just did this 3 times in 10 days. 3 margin hikes, each one designed to drain cash from long positions. December and January, they hit traders with hike after hike. Christmas Day hike, New Year's weekend hike. Every time traders caught their breath, another hike. Then came the kill shot. January 13th, percentage-based margins. Now when silver rises, your margin rises automatically. A trap that tightens itself. The higher it goes, the more cash you need. They didn't stop after the massacre. Monday morning, another hike, then another this week. 8 total in 8 weeks. For comparison, 2024 had 2 hikes the entire year. 2023 had 3. 2022 had 2. 7 hikes in 3 years was normal. 8 hikes in 8 weeks has never happened before. I went through 20 years of CME data. This is unprecedented. Each hike triggers forced selling. Forced selling pushes prices down. Lower prices trigger margin calls on other traders. More forced selling, more price drops, a death spiral by design. That death spiral is what you're watching right now. But here's the smoking gun. The thing that proves this isn't a normal market correction. It's a coordinated attack. Shanghai Futures Exchange raised margins the same day as CME, 20% increase. America and China, 14 time zones apart. These 2 nations agree on nothing. Trade war, sanctions, they argue at every international meeting. Except on silver. On silver margins, they moved in perfect lockstep. That doesn't happen by accident. That doesn't happen randomly. That happens when both exchanges are terrified of the same thing. And I know what they're scared of. March 27th. If you're watching this and you want to see where this story goes, drop a comment right now. Just type 300. And if this analysis is giving you a perspective you're not seeing anywhere else, hit that like button. It matters. Welcome to the hidden economy. I'm here to show you what's really happening while everyone else chases headlines. 356 to 1. That's the paper to physical ratio on COMEX right now. For every 1 ounce of real metal in the vault, 356 ounces exist on paper. 1 real ounce, 356 paper claims. This works perfectly when everyone settles in cash. But when people start demanding physical delivery, the math explodes, and people are demanding physical delivery. In the third week of January, 33 million ounces of silver walked out of COMEX vaults. Not traded, physically removed. That's 26% of everything they had in 1 week. The velocity of the drain is what matters here. It's accelerating. 4 years ago, COMEX held 430 million ounces total. Today, 113 million. 74% has vanished over time. Gone. First week of January, 7 million ounces left the system. By the third week, 33 million. The exit is becoming a stampede. Who is taking the silver? Not retail investors. Moving 33 million ounces requires trucks, security warehouses, logistics. This is institutional money. Manufacturers who need silver for production. Sovereign wealth funds, money that knows something. They're draining the vault before March. And there's a very specific reason why March matters. Let me show you the math. March futures contracts represent 528 million ounces of promised delivery. That's how much silver has been committed to traders. The vault currently has 113 million ounces available. Promised 528 million, have 113 million. Read those numbers again. They have promised almost 5 times more silver than physically exists in the entire COMEX warehouse system right now. First notice day is March 27th. That's when every trader holding a March contract must declare their intention clearly. Cash settlement or physical delivery? If just 22% of contract holders demand delivery, the vault is completely empty. Not tight, not stressed. Empty. What happens when the 23% shows up asking for their metal? Nobody knows. This is the scenario that COMEX and Shanghai are desperately trying to prevent. This is why we're seeing margin hikes. They need to shake out long positions before delivery demands expose the fractional reserve nature of the system. And it's working. Look at the price right now. Silver at $78, paper silver collapsing while physical holds at $100. Longs are being forced out through margin pressure. Traders who were right about the shortage are getting liquidated anyway. Being right doesn't matter if you can't survive the margin calls. That's the lesson here. Survival matters more than accuracy. Now here's what really kept me up last night. The timing of everything that happened in the last 2 weeks. It's too precise. Thursday evening, Reuters published a story claiming U.S. government was ending support for strategic metals. Anonymous sources. Algorithms triggered massive selling. The crash cascaded through markets. 3 hours later, Energy Department issued a statement. Quote, "The article is false and relies on sources that are misinformed or deliberately misleading." End quote. Completely false. But markets had already crashed. Algorithms don't reverse for corrections. The damage was done. Billions evaporated instantly. Also Thursday night, Kevin Warsh Fed chair nomination leaked to media. Hawkish stance. Bad for precious metals sentiment. Official announcement came Friday morning. But insiders knew Thursday night. Someone always knows before the public does. Fake news story. Leaked Fed nomination. 8 margin hikes in 8 weeks. All in the same narrow time window. Connect those dots. Now let me show you something I found this morning that nobody in mainstream media is reporting or even acknowledging. The day before the crash, Thursday, there was unusual options activity on silver ETFs. Massive put buying, huge bets on collapse. Someone made enormous bets that silver would crash the next day. Either someone got incredibly lucky, or someone knew exactly what was coming. I'm not alleging crimes here. I'm pointing out patterns. Put buying before crashes. Margin hikes during bull runs. Coordinated timing. You can draw your own conclusions about what these patterns mean. I'm just showing you the data that exists in public records. Here's who benefits when silver crashes this hard. JP Morgan holds one of the largest silver short positions in history. Over a decade of shorting. Every dollar silver drops, they profit hundreds of millions. Bank of America, massive shorts as well. HSBC, also heavily short. These banks sit on CME committees. They have visibility into positioning data. They see pressure points. Friday, when silver crashed 35%, regular traders lost billions. These banks made billions. Today, as silver sits at $78, more profits. I'm not saying anything illegal happened. Short selling is legal. Exchange committees are legal. These are just facts about structure. The entities who profit most from crashes are the same entities with the most influence over exchange policy and margin decisions. What you make of that is up to you. I'm just connecting publicly available information that anyone can verify independently. Now let me show you what happened to traders who tried to exit during the crash. They couldn't. Systems froze. In China, the UBS SDIC silver fund was completely halted. Not slowed down, not restricted. Completely frozen. 0 trades. Entire trading session. Not a single order executed. No buying allowed, no selling allowed, nothing. Complete lockdown. Imagine watching silver crash 30% in real time and not being able to sell. Clicking the sell button, nothing happens. Refreshing the page, still nothing. Calling customer service, hold music, watching your net worth evaporate minute by minute. That's what happened to thousands of Chinese investors last week. The exit door was locked while the building burned. In the US, ProShares Ultra Silver dropped 62% in one session. If you had a $100,000 Thursday night, you had $38,000 Friday. 62% of your money gone in a single trading day. iShares. Silver Trust dropped 31%. Worst day in the fund's entire history. But the price drops weren't even the worst part of what happened. Traders tried to sell, orders rejected, platforms showed errors, systems overloaded, customer service phone lines with wait times over 2 hours. And when you finally got through, nothing they could do. One trader contacted me saying he tried to close his futures position for 18 hours straight. Every single order rejected. Watching his account drain dollar by dollar, thousand by thousand, with absolutely no ability to stop the bleeding. Zero control. As of last night, some traders were still reporting account access issues. Days later, still unable to see their balances clearly. Still unable to execute trades normally. Still locked out of their own accounts. They crashed the price, then blocked the exits. Think about that sequence carefully. Crash the price. Lock the exits. Raise margins again. If you were designing a system to destroy longs, to transfer wealth from retail traders to institutional shorts, this is exactly the mechanism you would build. Exactly this. Now here's the fundamental picture that makes this entire crash even more absurd when you look at actual supply and demand. Silver has been in supply deficit for 5 consecutive years. Not surplus, deficit. Demand exceeds supply. Every single year. Solar panels need it. Electric vehicles need it. AI chips need it. iPhones need it. Industrial demand is exploding worldwide. Mine supply is essentially flat. Can't just turn on new silver mines overnight. It takes years to develop new production capacity. The cumulative shortfall since 2019 is 1.3 billion ounces. That's 18 months of total global production. Gone, consumed, vanished. And then China made a move that changed everything for the Western world. January 1st, 2026, silver added to strategic materials list. Export licenses now required for all silver leaving China. Volumes down 40% since the announcement. Essentially a slow motion ban. China refines 65% of the world's silver. They just told the West to find another supplier. There is no other supplier at scale, so we have 5-year supply deficit, exploding industrial demand, China restricting exports, and the price is crashing. Make it make sense. The only way this makes sense is if paper prices are being pushed down before March, delivery demands expose the shortage. Physical reality hasn't changed. The deficit is real. The demand is real. China's restrictions are real. Only paper is crashing. And it's not just traders getting hurt by this. Real businesses around the world are being destroyed by this volatility. In India, jewelry trading hub of Rajkot, 44 firms declared bankruptcy in the last week. $425 million in losses. Firms gone overnight. Families who have been in the silver trade for generations, wiped out. Not because of bad business decisions, because of price manipulation. In London, 2 hedge funds suspended redemptions. They cannot give investors their money back. Silver positions underwater, can't sell. In Dubai, physical silver premiums spiked to 15% over spot price. Dealers cannot get enough metal to meet actual customer demand. This crash is creating real wreckage across the entire global financial system. And we are only a few days into this situation. Now connect all the dots I've shown you. 5-year supply deficit, exploding demand, China restricting 65% of global refining capacity. COMEX promised 429 million ounces, but has 85 million. Vaults draining 26% per week. Shanghai paying $100 while paper trades at $70. 8 margin hikes in 8 weeks. Platforms freezing during the crash. 44 firms bankrupt. Hedge funds suspending redemptions. The price crashing while physical premiums spike. Does this look like a normal market to you? Does any of this seem natural? I think physical wins eventually. I think it always wins throughout history. Paper promises can be printed infinitely. Metal cannot. But right now, in this moment, paper is winning the battle. Silver at $78. Longs being liquidated, shorts making billions daily. The question isn't whether physical reality eventually reasserts itself. The question is whether you can survive until that moment arrives. Whether you can hold through the pain, whether your stops got hit, whether margin calls forced you out before you were proven right. That trader who messaged me Sunday night, he was right about everything. The shortage is real. The manipulation is visible. He still lost everything. Being right doesn't pay the bills if you get liquidated first. That's the harsh lesson of markets like this. Survival beats accuracy. So what happens next? Where does this crash end? Nobody can tell you exactly where the bottom is with absolute certainty. Anyone claiming they know the exact price level is lying to you. I'm not going to give you price targets. Targets are meaningless right now. In a crash like this, support levels that should hold are breaking like glass. Technical analysis fails when forced liquidations dominate. What I can tell you is what to watch for. Not price levels, something more important. The signs that tell you what's really happening. The data points that separate real crashes from manufactured ones. The signals that show whether this is ending or getting worse. Here's what makes me think this is not the end of the story. And this is critical. Pay very close attention to this pattern. Shanghai Premium is not collapsing with paper prices. Physical buyers are still paying $100, while paper trades at $78, still holding firm. If this was a real crash driven by fundamentals, if supply and demand actually justified these prices, physical would be crashing too. It's not. Physical is holding. That gap tells you everything you need to know about what's real and what's fake in this market. Lease rates are at 10% right now. That's 20 times higher than normal. Institutions are desperate for physical metal, paying huge premiums to borrow. You don't pay 10% to borrow something you think is about to get cheaper. You pay 10% because you need it now. Can't find it anywhere. Vault drain continues despite the crash. Smart money is still taking physical delivery. 33 million ounces last week, probably more this week. While retail traders panic and sell paper, institutions are backing up trucks. They're removing metal from the system. Actions speak louder. March open interest is still elevated. Despite the crash, despite the margin hikes, despite everything. Traders are still holding March positions. They still want delivery. They haven't given up. They're taking the pain. Waiting for first notice day. That tells you something important. The fundamentals haven't changed. Not one bit. The deficit is still real. 5 consecutive years. The shortage is still real and growing. China is still restricting exports of 65% of global refining capacity. Industrial demand is still growing every single day. Solar, EVs, AI chips. What has changed is only the paper price. Only the paper price. Pushed down through 8 margin hikes and cascading forced liquidations. At some point, paper has to reconcile with physical reality. It always does, throughout all of history, every single time. Physical wins. The only question is how much damage happens first. How many traders get wiped out? How low does paper go before the system breaks? I think physical wins. I think it always wins. Paper can be printed infinitely. Central banks can create unlimited paper claims. Metal cannot. That truth has held for 5,000 years of human civilization. It's not going to stop being true now, but timing matters for survival. Here's what panicking retail misses in moments like this. Crashes don't destroy wealth. They transfer it. Money doesn't disappear. It moves. Friday, wealth moved from retail traders to banks. Billions transferred in hours. When this reverses, and it will, wealth moves back. The question is, which side of that transfer you're on when it happens. Are you the one transferring wealth out or receiving it back? Paper at $78, physical at $100. That's a $22 gap. That gap closes eventually, always does. Someone profits massively when it does. Here's what I'm watching closely. These are the numbers that will tell you what happens next. The real indicators that matter most, the Shanghai Premium, currently $22. This is the truth teller. The gap between what paper says silver is worth and what physical buyers pay. If this gap widens to $30 or $40, paper is losing all credibility. Nobody believes paper pricing anymore. It's system breaking down. If it narrows because physical starts dropping to meet paper, then maybe the manipulation thesis is wrong. Maybe this is real demand destruction. If it narrows because physical starts dropping to meet paper, then maybe the manipulation thesis is wrong. Maybe this is real demand destruction. But if it narrows because paper rises to meet physical, that's when you know the game is changing. That's the inflection point. COMEX vault levels. Every Friday they release the data. Last week, 33 million ounces walked out. This Friday's number is critical. If another 20 or 30 million leaves this week, vault will be nearly empty before March. Who's taking this metal? Where's it going? Why are institutions paying for trucks and security to move physical silver while the price is crashing? They know something we're finding out. Lease rates, currently 8 to 10%. Normal is 0.5%. This is what institutions pay to borrow physical silver for short periods. When lease rates spike like this, it means physical metal is impossible to find. Last 2 times, lease rates hit these levels were 1980 and 2011. Both times, something very significant happened shortly after. Price explosions, short squeezes. System stress became system breaks. History rhymes. March, open interest. How many contracts are still open for March delivery? If traders are capitulating and closing, open interest drops fast. If traders are holding despite the pain, despite margin calls, despite everything, open interest stays elevated. Shows conviction and resolve. High open interest going into first notice day means delivery pressure, real pressure. That's exactly what exchanges are trying to avoid here. System stress indicators, trading halts, platform freezes, account lockouts. If more funds get halted, like UBS SDIC, red flag, system breaking. If more platforms freeze like we saw last week, system under extreme stress. Functioning markets don't freeze. Stressed markets do. Broken ones do: Shanghai premium, vault levels, lease rates, March open interest, system stress. Track these 5 things closely. Watch the data every day. The data tells you what's happening before anyone else figures it out, before mainstream media reports it, before it becomes obvious to everyone. Shanghai premium widening means paper losing all credibility. Lease rates spiking means institutions cannot find physical metal anywhere. Vaults emptying means shortage is accelerating. Platforms freezing means the system itself is breaking down. These aren't just numbers on a screen, they're warning lights flashing red. Here's what I want you to understand about what you're watching right now in real time. This crash is not random, not organic. It's not normal market behavior. It's not just profit taking after a rally. 8 margin hikes in 8 weeks. That's unprecedented in 20 years. CME and Shanghai coordinating on the same day. Nations that agree on nothing moving together. Unusual options activity day before the crash. Someone knew. $22 gap between paper and physical. Divergence that should not exist in efficient markets. Vaults draining at record pace. Smart money running for physical exits. Traders locked out of accounts, unable to execute trades. 44 firms bankrupt in India overnight. Hedge funds freezing redemptions. Cannot return investor money. Physical premiums spiking globally while prices crash. This is not a normal correction. This is a manufactured event designed to shake out long positions before March. Delivery demands expose the fractional reserve nature of the system. It's working. The pressure is working. Longs are being destroyed right now, this minute. But the fundamentals haven't changed at all. The shortage is real. The deficit is real. Physical is trading at $100 while paper trades at $78. Can't stay this way forever. At some point, this ends. Paper reconciles with physical. It always does. Question is whether you can survive until that moment arrives. Whether you can hold through the pain, whether your stops got hit, whether margin calls forced you out. That's what separates winners from losers. Ask yourself tonight, do I understand my exposure fully? Do I have an exit plan if this gets worse? Is my position sized for survival? Or am I one margin call away from losing everything like that trader who messaged me? Right about everything. Still destroyed. Still gone. The winners in markets like this aren't the ones who predict perfectly. They're the ones who survive, who manage risk properly, who stay calm, survive until clarity, then act decisively. This is not financial advice. Your money, your decisions, your responsibility, always your choice. But if you're watching silver at $78 while Shanghai pays $100, you need to understand what you're actually looking at right now. You need to see the complete picture, the margin hikes, the coordination, the physical divergence, the vault drain, the lease rate spike. That's what this video gave you, the full picture. Gold crashing, silver at $78, Shanghai at $100. The gap is screaming at you. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have survived. Someone will have seen what others missed. That could be you, or you could be the one who panicked at the worst possible moment. The difference is not luck. It's not prediction. It's risk management. It's survival. It's understanding what you're really watching unfold here. Drop your thoughts in the comments. Share this with someone who needs to see it. Subscribe if you want to follow this until it breaks. I'm covering this every single day until something gives, until paper breaks, until physical wins, until the truth becomes undeniable to everyone.